Tesla Incorporated is currently one of the most controversial companies in the public market, as experts are divided over the company's value and potential. While some feel that Tesla is highly overvalued because investors seem to ignore the risk of it being a car company and instead treat it more like a high-growth tech company, others claim the opposite is true, and here are 10 reasons why Tesla and its stock is undervalued. While Tesla may not be among the biggest companies right now, it will surely become one of the most valuable companies within the next decade or so. They have already been the leader in market-proven designs of electric cars for more than 5 years, as well as of the factories that produce these types of cars. They also have a 5+ year lead in autonomous driving, as well as in battery technology and manufacturing, and even if they were to turn their back on the car industry, they could still earn more than $100 billion per year revenue making batteries for countless applications. Whatever the future holds, Tesla definitely has a head start, as potential competitors already have a lot of catching up to do. A lot of skepticism towards Tesla and its value stems from the fact that most consumers haven't even considered acquiring a Tesla yet. As a result, many are oblivious to its key benefits such as safety, race car-like acceleration, and rapidly increasing semi-autonomous driving capabilities. And despite Tesla's stock already being worth 2 to 3 times more than the rest of the US car industry combined, it is still not considered a household name, neither by consumers nor investors, even though you can expect its value to increase significantly over the next 5 years or so. In late March 2016, Tesla introduced the prototype of their Model 3, which went into production in mid-2017. The official launch and delivery of the first 30 cars took place on July 28th, while it has been available in Europe since early 2019. As of March 2020, the Tesla Model 3 is the world's most popular and best-selling electric car in history, with more than 525,000 units sold and delivered. It has overtaken the Nissan Leaf in sales to become the all-time best-selling EV globally. In just 2.5 years of volume production, the Model 3 achieved sales that took the Leaf almost 10 years. The Model 3 was already the world's top-selling plug-in electric car in 2018 and 2019, and there's actually still plenty of room for quality improvement and price lowering, which will only lead to even more sales. Plus, the Model 3 is still just an early version of what Tesla is capable of, and it is probably safe to say that their Cybertruck, semi-truck, and future sedans are going to be even bigger hits in the US and the global market. Although Tesla is already profitable, there's still a lot of room for improvement. There are still many ways that the company can increase its gross margins, for example, by simply scaling up and optimizing everything further. In fact, Tesla is the youngest major car company and they have spent the least amount of time on this. So in addition to the growth that is to be expected by the company in general due to their current as well as their future projects, optimizing processes and scaling up could lead to even bigger gross margins, making their stock an interesting long-term investment. Tesla and its CEO Elon Musk have made the headlines uncountable times as the media follows every move the company makes. Some headlines may have been rather negative, but as the saying goes, any publicity is good publicity. Thanks to the detailed media coverage, the company has enjoyed an incredible amount of free advertising, while Elon Musk has an almost cult-like following, with nearly 39 million Twitter followers. All this attention means it's unbelievably easy for Tesla to reach a huge amount of people and spread the word about when new products become available. It also allows them to create a lot of demand for their products, as the huge amount of pre-orders for the Model 3 has shown in the past. Despite Tesla spending less than $50 million on marketing, promotional and advertising costs in 2016, they received 400,000 pre-orders for the Model 3, which went into production in July 2017. To put this into perspective, traditional car companies like General Motors, Ford, and Toyota still have to spend billions of dollars each year to advertise their products, despite having been around for many decades, which gives Tesla an incredible advantage. This is just speculation, but it seems like a lot of investors are not aware of the fact that other car companies are pretty much doomed right now, because they are way behind when it comes to environmentally friendlier cars. Within the next 5 years, any internal combustion engine car will not be competitive with any Tesla car on any level, and nearly all other companies in the $4 trillion a year car industry have had engines as their core competency for the longest time. They have invested a lot of effort, time, and money in something that has absolutely no long-term value, and even though most of them are dabbling in the field of electric vehicles, none of them have done enough to come even close to the level Tesla is at already, due to the innovator's dilemma. Although they were recently passed over for inclusion in the S&P 500 index, Tesla is probably only a few months away from meeting the profitability requirements to be included in the list. In fact, the exclusion from the index came as a surprise to many, considering that the mega-cap electric vehicle manufacturer ticked off all the eligibility requirements. But according to DataTrek, the committee likely thought that Tesla sits on shakier fundamentals than its August 31 market capitalization of $465.2 billion may indicate. Instead of Tesla, the committee added Etsy, Teradyne, and Catalent to the S&P 500 index, but Tesla will remain eligible for inclusion in the index if it continues to stay profitable in the future quarters, and once S&P decides to include them, a bunch of funds will automatically buy in, which will cause Tesla's stock to jump. One of the main concerns that critics of electric vehicles keep voicing is their fear of running out of charge on a longer trip and being stranded somewhere, and according to them, this is exactly what would prevent electric cars to become mass consumer goods. However, Tesla has responded in the best possible way and invested in its own network of rapid charging stations. As of March 2020, the company operates over 17,000 superchargers at 1,942 stations in its global network, and independent of the superchargers, the company also has Tesla destination chargers. As of September 2019, Tesla has distributed nearly 24,000 destination chargers to locations such as hotels, restaurants, and shopping centers worldwide. These chargers are slower than superchargers and are intended to charge cars over several hours free of charge to Tesla drivers who are customers of the business at the location. Creating such a large network of chargers has given Tesla several advantages, as they not only squash concerns about the limited range of EVs and thus turn potential buyers into owners, but the charging stations also serve as a great way of advertising the company's brand and products, since they are placed along well-traveled routes all around the globe. Building this widespread network may have cost Tesla millions and taken several years, but it is actually yet another advantage for the company, since it means it will be pretty hard for the competition to catch up. There are few companies with more optionality and market opportunities than Tesla, because even if they stuck to just the car industry, the company has a lot of potential. Beyond the Model S, Model X, Model 3, and Model Y, Tesla is also working on a pickup truck, a heavy-duty truck, and a high-passenger density urban transport. In addition, they could launch their own Uber-like service and autonomous vehicles, which means the company has incredibly huge potential in the automotive industry alone. And this doesn't even take into consideration the potential of personal and grid-level storage products like the Powerwall or Powerpack, or the sale of solar panels and the new solar roof. The Tesla stock still seems like a risky bet to some, while others believe that the long-term advantages of investing in the company are far bigger than the risks of such an investment. As we just hinted at, Tesla may not be the best short-term bet, but could be a really good investment in the long run, provided that there will be a significant electric vehicle market in the future. According to Morgan Stanley's lead auto analyst Adam Jonas, Tesla is fundamentally overvalued, but strategically undervalued. What that means is that investors have bid the company's value up too high when it is still unclear whether there will be ongoing sustainable demands for its vehicles. At this point, the EV market is still incredibly small, but Tesla has been recording triple-digit quarterly percentage gains year over year, and in recent years, the entire auto industry has been moving toward electrification, driven for the most part by the need to balance rising sales of pickup trucks and SUVs with the upcoming government requirements for higher fuel economy and lower emissions. The latter is determined by car manufacturers' entire fleets, so electric vehicles are a good way to balance things out and achieve compliance. However, most big car companies still produce an incredibly low amount of electric vehicles, while Tesla boasts a 100% all-electric fleet and is way ahead of its competitors. Currently, Tesla effectively holds a monopoly on premium electric cars, which means the company's shares are highly undervalued. Jonas's claim is even supported by numbers, as Tesla stock has returned close to 800% and at times even more than 1,000% since the company's IPO in 2010.